Welcome back, everybody, to the Investors Roundtable. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BobbyKKRAFT. And we have I'm really excited about this topic today because it's a microcap focused topic. You know, we don't always just talk microcaps on this show, but today we're going to be talking microcaps because it's a question that I've been getting from all walks of my universe. So, you know, why are microcaps surging? You know, what's happening with microcaps right now? So I figured I'd get some of the best minds I know in microcaps to come on and let's chat about it. So, you know, going counterclockwise from what I see, starting off, we got Kevin Shea at The Good Prick. Thank you, Kevin, for joining us today. We got Maj Soueidan from GeoInvesting.com, where you can get a 7-day free trial on his newsletter, GeoInvesting.com. Maj, I got you. Don't worry. And we also got Yaron Naymark joining us from One Main Capital. What's up, Yaron? And all right, let's dig right in. The question: why are microcaps surging? Whether that's right now or in 2020, I think we could just talk in general that microcaps have been surging. So I'm going to go to Yaron first on this one. So Yaron, love to get your take on this. Why are microcaps surging right now?
Yeah, I think there's probably a few reasons. I think the most important reason is just that I think forward expectations for economic growth being distributed across the broader economy have just gone up. I think that's due to a combination of increased consumer confidence and more savings throughout the pandemic. I think people have managed to save up some money, and the expectation that fiscal stimulus is not only started, but is going to continue to accelerate over the coming few years. So over the last, call it 5 years, there's been a lot of monetary stimulus. That's included the Fed lowering interest rates and purchasing assets, which have helped asset prices, but haven't really helped small businesses that much. And now people are starting to get checks from the government. You know, they're getting direct checks from the government, whether it's enhanced unemployment benefits or just stimulus checks, 600, maybe going to 2,000. And when you know, your average Joe gets $2,000 into his bank account, injected into his bank account, he's much more likely to go out and spend that in the real world. So it'll help restaurants, it'll help retailers, it'll help car manufacturers. And so I think forward expectations for profits for these smaller businesses have gone up. And then I also think you kind of have this Robin Hood effect where individual investors are just more active in the stock market than they've been in a really long time. Excuse me. They're more active in the stock market than they've been in a really long time, and more money is flowing into the stock market. I saw a really interesting chart over the last few days that, you know, the smallest stock price, the lowest stock prices have been up in the highest in terms of percentages over the last few months. And it's interesting. I just think, you know, retail investors who are unsophisticated come and they see $5 stocks and they're like, oh, that's more affordable than a $500 stock. So they're putting more money into these smaller cap names with smaller market caps and lower share prices. And due to lack of liquidity, as more money flows into the market, especially in small caps and micro caps, you know, there's a lack of liquidity. So if that money is trying to flow into these stocks, they're you know, they have to be pushing the stock prices up. So those are kind of the two things I see. Not sure if any of you guys have any other ones that you're willing to point to.
Yeah, Maj, Kevin, you guys want to jump in?
I'll go. Yeah, I agree with the macro on that, Yaron. There's quite a bit of economics that are driving availability of money to be spent in these opportunities. I also look at that you said, the future-looking issues that one has to consider with regard to microcaps. And of course, we've all learned that getting in early with a microcap is going to give you the highest level of return over the longer period of time. So one of the things that I think is looking good here is that there are a number of different, let's call them disruptive markets that are being developed, that are taking in a lot of money. They include, of course, the electric vehicle marketplace. It's going to drive for the next 15, 20 years. So I think people are looking at the opportunity that provides. People are looking at things such as blockchain and Bitcoin. Similarly, I mean, highly disruptive market areas. I mean, looking at fintech, which is another market area, growth opportunity in the digital space. There are a number of different methods. There are a number of different sectors, I think, that are indeed opportunistic and also longer term that give an investor the potential of having a multi-year high growth opportunities in these small companies. So not only is the money available, but I think that the opportunity that exists, again, I keep going back to this idea of innovation cycle. I think the innovations that are going on right now are broad and deep. So I think that one can actually look at these things and sit down and as I was noting, take a look at what might be a long-term investment. Again, that there's not saying that there's a lot of long-term investments also discounts the fact that there's a lot of speculative opportunities going on right now. And those things can also drive some of the prices that we're seeing.
All right, Maj, you want to give your first take and then we'll dig into some of the things that everyone said here?
Yeah, I think I really agree with everything they've both said there, Kevin. One thing I wanted to add is that, I think we saw was interesting even before 2020 came around and before COVID, that we saw some strength in the, smaller cap market kind of start to percolate in maybe 2018 and really gain some strength in 2019, which was nice. And, now there's, to add to some of your points there regarding the Robinhooders and, crypto and retail investors, it just basically, I think we're getting we had the whole 2008 crisis came along. We lost a lot of investors, retail investors that would invest in the space. And it just takes a long time to cycle, after that cycle to play out and get new investors involved. You need the retail investors in this nano cap place to start, get the volume going. And they slowly came back. And I think really a turning point was when crypto really got in 2017, crypto really kind of started taking off. You started breaking, and then the crypto crash occurred. So you had all these new retail investors, millennials getting involved, in crypto, and maybe they started finding the stock market and these nano caps as another outlet to really start looking at it. And you had Robinhood, percolating at the same time. So I think all those things really helped bring a new investor into the space. I think there were 10 million new retail investors created in 2020. I was reading that somewhere. And a lot of them were actually women too, which I'm very excited about that trend. I think there's a lot of women who are getting involved in investing now. And another interesting thing I read too was that a lot of the new money is going into stock picking, and not necessarily, not necessarily funds, which is really good for our space because that's where you find, a lot of the value and stuff. And kudos to Michael Burry. I think Michael Burry called it sometime in 2017 that hey, there's going to be a shift out of, into smaller cap and smaller names, and he kind of hit it on the timing on the head, just like he hit the big short at the time around that one too. So he got that right. So yeah, I'm just and something else was pretty interesting I'm noticing too is that the whole pump and dump kind of scheme is, was really for a long time, reserved for the really low quality companies, a lot of biotechs, a lot of just, the marijuanas or cryptos. But you're starting to see some of that pump and dump activity kind of shift into smaller names. The IVFH last week, I thought 2 weeks ago, pumped from like 60 cents to almost $1, like in a minute. I know some other ones going. So it's pretty interesting seeing that some of I think the pump and dump game is getting tired, and they're just trying to find, investors trying to find new names to good or bad to pump them. So look, we have, I know we don't like pump and dumps and, and maybe we don't like it. We talk about some of the inexperienced investors maybe getting involved in the market, but it's actually good for the market in the end. It brings a lot of more volume to the whole broader area that we invest in nano cap. So, I'm really excited about that trend and see if it can continue.
Hey, Maj, real quick, are you a shareholder in IVFH?
I am, yes.
Okay. So
for a long time. I was like, yes, finally. And then it went right back down, by the way. So.
Well, I mean, that's a pretty interesting take there. That pump and dumps are potentially good for the market right now. That is something I didn't say
good for the market. Don't put words on my mouth.
All right, I'm sorry. I take that back.
I mean, I think it's bad in terms of it brings, it definitely gives us sharp movements in some of these stocks, but it doesn't necessarily bring a great investor into your stock. So then you have to deal with the unwinding of that over several quarters sometimes, after because these guys people don't care about the stock. They don't know what they're buying. So I don't think it's great, but it certainly is bringing awareness. And a lot of that pump and dump activity is occurring, as was mentioned earlier, in these penny stocks, like under $1 or $2. I've noticed.
But I mean, are you seeing it? Are you seeing like the actively, like what we used to see, like the active paid promotion? Or are you talking about like, you know, somebody that might have a massive following on StockTwits or Twitter, you know, happening to mention it? Because I know that there's a lot of these influencers that have an effect on the markets in ways that are, you know, you just, back in the day, I'm sure those pump and dump schemers would have been like, damn, I wish I had a Twitter following like that, you know, this would make my job much easier, you know. But I mean, is it active promoting going on in some of these names, or, you know, is this just potentially quality names that are now getting picked up by some of these people that might kind of know what they're doing, but because of their influence now, they're rocketing as a result of them mentioning the name? I don't know
about you guys. I haven't seen a lot of, you know, the pump and dump games change over time. I mean, I think a lot of it just Twitter now, and I know the IVFH pump, I think, was just a tweet by an individual or an outfit that had a lot of followers. This is the only thing I could see.
I do sense that if you're looking at the topic of microcap surging and all that, it is brought on by both activities. One is the opportunity to invest in things that are long-term, yet at the same time, a lot of speculative trading, very, very quick trading. You'll see various issues have trading of an average daily volume of 80,000 shares, and then on one day it'll be 75 million. You see it regularly. I mean, it's happening all the time. I mean, I'm just shocked by it, and I write a little bit about it, saying I stay away from those things. But I think.
I mean, what was the name? Sorry, Kevin, I didn't mean to interrupt you. What was the name last week? What was it? Signal Advance or something like that? What was?
Yeah, it was the wrong signal. Yeah.
Yeah, it was the wrong signal that I think Elon Musk tweeted out, and everyone was like, ah. Yeah. And I think it was like a completely illiquid pink sheet company that like skyrocketed on nothing.
It's really quite funny as you do see these
a shareholder in that name,
massive rises in volume, and that I think is driven a lot by speculation and day trading. And one of the fellows said about everybody staying at home and have their $2,000 ready to invest, and I think there's quite a bit of that going on. Whether or not it's the Robin Hood effect, or whether or not it's the day trading effect, or whatever it is, it definitely exists. I prefer to look at microcap activity from a standpoint of an investor, and seeing what gives, and you know what's good from a standpoint of a long-term return. Again, as I mentioned, I think that you're looking at. I mean, I like electric batteries. I like that space. I mean, it's going to be changing dramatically over the next few years. I mean, everybody's focusing on it. You're looking at batteries. If you look at batteries, you have to look at the miners. You have to look at graphite. You have to look at cobalt. You have to look at lithium. Every time you sit down and tap into the electric vehicle space, you're sitting there looking at it going, wow. Even Musk, he's a proponent of nuclear power for a number of reasons, which we can get into if you wanted to. However, his comment about that has spurred on the uranium business. So the uranium stocks are doing quite well. So again, you look at some of these things and you start putting pieces together, it does say, where's the electricity there? What's the transmission grid going to look like? Things of that type. You know, are they going to be a transformer or a device in everybody's home? So you know, when you start looking at various expanding markets, how does it look? I mean, from the investor's perspective. As I was saying, again, I'm not going to get into the crypto thing because I don't know it very well. So again, cannabis is the same thing. What happens to the cannabis market in the short term if the new administration basically opens it up to non-regulatory federal reactions?
So Kevin, you're hitting on something that Maj just alluded to. I mean, and Yaron, I'd like to get your opinion on this as well. Is, you know, are we seeing this microcap surge because you're starting to see a greater interest in some of these disruptive markets? I mean, is that really what's driving a lot of the volumes that we're seeing in some of these stocks that we wouldn't have otherwise?
Yeah, look, I think Maj touched on it a little bit. Like, after 2008, retail investors stopped trusting the stock market, right? They got burned in 2001 after the dot-com bubble collapsed. Then they got burned in 2008 when the housing bubble collapsed. And a lot of millennials and, you know, middle-aged people were like, man, I saw my parents and my grandparents and like me a little bit lose a lot of money after the dot-com bubble burst and after the housing bubble burst. Like, it's only a matter of time before it bursts again. And I just don't trust the stock market. And it takes a long time to work through those scars and get people to come back in. So I think, unfortunately, over the last, 10 to 12 years, retail participation has been lower than it probably should have been. And the average American has been less invested in the stock market, which has done really well. The stock market's done very well. So they've watched the very wealthy do very well while they've kind of sat on the sidelines. And so I think getting them back involved is very good. The long-term expected return of the stock market is well in excess of inflation, in my opinion. And so that you're creating real wealth for yourself if you invest in the stock market and you don't do anything stupid over time. So I think it's healthy. It's good that they're coming back in. It's good for asset prices, obviously more capital flowing into equities, but also it's good for savers. I think the unfortunate part is that you are seeing a lot of speculative activity, and that speculative activity is going to lead to some people having subpar results, and it works in the short term for them. They're all doing really well right now because it's a popularity contest and it's a casino, and people are stuck at home and they were bored, and the hot name of the week is the one you buy that goes up 3x in the next month, and you feel really smart. And I think the worst thing anyone can do is walk into a casino and have a huge night on their first time playing blackjack or craps or something because you think it's easy, and it's not. Long term, it's not easy. And what happens is you get overly aggressive into situations that end up not being in your favor, and then you get blown up, and then you stop trusting the market again. So it could end up being a big wealth destruction opportunity for a lot of people who think they're going to create a lot of wealth for themselves. Hopefully that's not the case. And the saddest part is that you see a lot of promoters who understand the game who are coming to take advantage of these unsophisticated investors. So it's not just CEOs who are pump and dumpers. There are there are people who are bringing companies to public, bringing companies public that should not be public. There are business models that are uneconomic today and probably won't ever be economic, that are raising a lot of capital on lies and promotion that, they know they're selling you a bag of goods. It's not true, but they're raising capital off of it, and they're paying themselves big salaries and selling their own stock into it. And it's the equivalent of theft, really. You're stealing from less sophisticated people when you're doing that. I'm all for, innovative companies having a lower cost of capital. I think it's great for the world, for innovation. If you have a true visionary CEO who wants to create a product or a service that's going to be really good for society, I want them to have a low cost of funds. And I think that's good that, that society is willing to fund a lot of these innovators with low cost of funds. The unfortunate part is that you do have these leeches who come and take advantage of that. So, the only thing I would say is I would encourage any new investor to really study history and know that it's not easy to make 500% gains a year, even if you see people on Twitter saying they're doing it and telling you exactly what you need to do it. And don't use leverage and debt, until you really know what you're doing. It's dangerous, and you could blow yourself up.
That's very well spoken. I think that every point that you've made is one that everybody should be listening to. Again, to go back, you mentioned it, and I did a little bit of research before we joined here today on the dot-bomb situation in 2001, 2002, and everything went to bed. I do see that as historical, and as Yaron just said, is that if you don't know what history has offered, then you really are going to be in a situation where you're going to get taken. So there are so many what you were saying, Yaron, was very, very similar to what happened back in 2001, 2002, 2000 and 2001, when everything really started to go down. However, the thing that did happen out of the dot-bomb situation was, of course, there were too many companies that were getting too much money, and the VCs were passing money around like it was candy. However, there were a number of companies that basically did very, very well out of that because they were well controlled. Again, Amazon came out of it, Wayfair came out of it, but a number of different things. There were a few more companies like that. There are also other companies that tried to do something, like Pets.com. And now, of course, what you have is you have Petco and you have Chewy and things of that type. So the ideas that were there were actually quite reasonable. However, these small companies were spending wildly at whatever and trying to get money. They ran out of capital. So again, what happened was that they were trying to grow very rapidly to suit the needs of the market, suit the needs of the VCs. VCs would take them out early, and all of a sudden it all collapsed. So it was a very fascinating period of time where the same speculation occurred. I mean, there was money chasing every stinking deal, and any IPO that went out was rapidly taken up. So again, I have to look back in historical times and sit down and see, what we are looking at here, is it more consistent with the internet boom, the dot-bomb boom, more so than the housing market? I mean, I'm not quite sure whether or not there's a corollary in the investments that were made by retail investors and microcap investors. Maybe there is another opinion here, but it's, again, it's one of those things where I think that hindsight is 2020, or hindsight is pure science. So I think one should look back to see whether or not we're actually in what might be a bubble at this point in time.
Kevin, what was nice though about that time too, Kevin, that when the bubble did burst, which was horrible short term, it did actually start bringing a lot of these companies that were ignored. These like nice value companies that were ignored during the whole dot-com rush, and those stocks are actually outperforming relatively quicker when we came out of it. So if we have a bubble here that bursts, I'm hopefully optimistic that as long as the burst isn't a financial destruction, like a banking issue or something, that you'll start seeing a higher quality microcaps continue to gain interest as people look there too. So I remember that there were a lot of companies I owned during .com that weren't moving, that were really attractive, but the money wasn't chasing them. And then when the bubble burst, the money started chasing those higher quality companies. So that might be an interesting fallout if we do get what you're talking about.
Well, Maj, that's actually a great point. Sorry, Kevin, I didn't mean to interrupt you there, but that's something I wanted to follow up on with you. And I'm glad you brought this up because, I was chatting with my dad about this, because he's, has seen a few of these markets. And what? Yeah, he's an OG. That's for sure. That's for sure. And so, one of the points he made that I thought was interesting is that, when you've seen this at other times and now happening again, is especially with microcaps, one of the biggest complaints over the last few years is that you're just not seeing enough quality companies going public earlier in their life cycles. And I don't know if maybe there's an influence here with the SPAC market, and now there's more of an infrastructure where more companies are not considering going public a little bit earlier or during various things, or maybe going public on other markets because it's easier. But at the same time, it still seems like the reason for some of them, the micro, or why microcaps in general might be surging, is because there's too much money chasing fewer names. I mean, Maj, what do you think about that? Tell me if I'm wrong, please let me know. Remember, I'm crowdsourcing my thoughts here on this.
Yeah, I don't know what to think of the SPAC market just yet. It seems like it's a new .com. I don't know how it's going to all play out, but look, it is making people some money if they're getting in early, and maybe time will tell if these SPACs do play out. I don't think history is Kevin. Look at history, like Kevin says, the SPAC investment usually isn't a great one, at least fundamentally, at least for these companies. But you made a great point about what is going on with these new IPOs and new kind of these new stocks going public, and that's why I really focus a lot what I call these tier one companies, tier one nano caps or microcaps. And these are companies that have, management teams of at least 20 or 30 years. They've been out there for a long time. There just seems to be something different with those teams than the new team. We're focused on short term now. There's a lot of disruptive stuff going on. So, it definitely plays into I don't know what to think of it, man, Bobby, but I just do not. I know I'm concentrating on all these wonderful companies that have been on for a long time, finding new ways to do things, and maybe getting new management teams in place. They just hung around for years and years through all these economic cycles. And when things happen, even disruptive stuff happens, they adapt. I mean, just because you're an old company doesn't mean you can adapt to new disruptive technologies. I mean, COVID-19 has created a whole bunch of new industries for a lot of these older companies to reinvent themselves, and actually new demand for new things, even the EV stuff and even the cannabis market. So I'm really concentrating on how does all this new stuff going on, these technologies and movements, how is it going to affect some of these really old, proven companies that can
Well,
see a really uptick in their growth?
I mean, that's my main point, is that we're seeing some of the similar things that what you and Kevin and Yaron have said here, is that it's not like this money that's really actively investing in the market. Yeah, a few quality names are mixing in there with higher volumes that they normally have, but for the most part, those tier one names are still getting completely overlooked.
I wouldn't say, I mean, they're percolating. I mean, it's not as bad as it was 5 years ago, put it that way.
Okay.
I mean, you have a bunch of stocks I'm looking at right now that are going crazy. So, it's better. It's much more, and just in general, the money is more broad. It's more money. There's more money coming in the market just in general. So there's a broader kind of allocation of it. Yes, I think you're right that the tier one names aren't maybe getting the love they should get, or that we think they should get, at least that we
Because
think.
they're not EV, like they're not hitting on some of these themes. So,
But smart money, if you want to use that phrase, who does see it? I mean, ultimately, you look at the movement in AMD, which I don't own. They have been associated with the Bitcoin mining, and as a result, their stock has done well. Same thing with Nvidia, again, which I don't own. So there you have the tier one impact of these new markets that are being developed. And again, I mean, as Maj was saying, is that these older companies reinvent themselves, or certainly adapt to what they can provide to the marketplace. So I think he's right on the money on that. However, there are other companies. I mean, I started looking at a few companies again. So there's a company out there that's doing less than $1 million in revenue. This is an EV business. They're doing less than $1 million in revenue. They have a $3 billion market cap. I mean, it's crazy. And I've gone through a few more. It's the same thing. And another company has, less than $1 million in revenue, and they have these ridiculous market cap, $600 million market cap on one of these things. But $3 billion for something. I mean, you look at another company. This battery company just came out, Quantum Space, which I don't own. They have zero revenue. And at one time they had zero revenue, and at one point in time they had market cap bigger than Ford Motor Company. I mean, this is where you start to sit down and say, "Whoa, this is getting a little bit bubbly around. At least it's getting frothy." Put it that way, okay? Frothy. So one has to consider is are these telltale signs that we're seeing with these, and again, Maj used the word crazy types of things going on. Are they indicative of anything? So again, I mean, one has to go back and sit down and say, can one learn craziness if one goes back and look at the .com, .bomb type of situation?
Yeah. By the way, I don't necessarily think that the overall market is expensive. There's a lot of really good value out there, and the overall market multiple to me doesn't scream watch out. The really big cap, stable businesses don't strike me as too expensive. There's a lot of small caps that I think are really attractively valued, but there are definitely pockets, not just of froth. There are pockets of complete craziness and euphoria where people will get burned. It's just a question of time. And could they keep going up more first? Yes, they very well could. I would not short these names as they're going parabolic. But at the end of the day, it's a game of musical chairs, and anyone who thinks they know when the music's about to stop is fooling themselves. If you're small and nimble and liquid, and you're good at reading charts and technical analysis, and you're in front of your screen 24/7 and are ready to blow out at any moment, then fine, you could play the game, but there are going to be people holding the bag. And so it's unfortunate. I think that anyone who, is investing money that they need for the future, that's not just inherited wealth, that's, play money, I think should really be paying attention to what they own and know what they own at these, in today's world.
That's a great point, man. And it's and thing is there's bubbles and there's bubbles. I mean, there's bubbles in investment styles where you have crypto blow up, pop blow up, maybe the SPAC thing blows up, and there's bubbles that affect the entire economy. They're two different things. So, I'm definitely, I'm not too worried about these bubbles being created, just as long as there's all this other value we can invest in, and it's not going to affect, companies negatively on a broad spectrum, like if you have a financial crisis or something like that, So bubbles are, these bubbles are, natural. It's a whole part of the ebb and flow of the market, and I'm not too worried about it, but it's interesting to watch it. And, and if you have a little speculative taste to play it and make some money in it. Certainly shouldn't be I think what the problem with a lot of these retail newer investors that get involved, it's most other strategy. It's the core of their strategy is to follow these hot trends. They're not looking at what the companies are worth. They don't care. They don't think they have to care, because in the last 10, since 2008, we've seen these crazy bubbles last for a long time. And at some point it matters, these pockets will blow up, and I'm just worried that some of these investors who don't know what they're investing in are just going to get blown up. And we're going to take advantage. I mean, if you know what you're investing in, we're going to take advantage of market dips and go and buy these companies that are falling unfairly too. So it's good to see those bubbles occur too, because it gives us opportunity to jump in there.
By the way, I do also, part of me wonders how much Twitter has amplified what a new bubble could look like, today versus back in the day, because you do have a lot of people posting, and Wall Street Bets, for example, people are posting screenshots of 7-8 figure accounts where they're like, I put 50 grand into Tesla 6 years ago and now I'm worth 10 million bucks. Or, here's how you make money. And the ones that kind of make their way up to the that win the popularity contest are the ones where they make it seem really easy. And it's just so easy to get millions and millions and millions of people to hear that story and think it's doable. And you're selling the dream instead of one person who made $1 million by speculating, telling 5 friends, you have one person who made $1 million by speculating, telling 5 million people who now like it and retweet it and share it. And so things could get way, way crazier. Who knows? But again, you definitely should know what you own, and you shouldn't gamble with money that you can't lose. And
you're right. You're so right, because and then the way with all the money coming into the market, even from the government and stuff, it can support that type of activity for a long time. And I always said a popularity contest. That's awesome, because let's not assume that these influencers or Twitter handlers are making money, by the way. I mean, they're saying they are, right? And so they're selling that dream, like you said. And if you look on YouTube, every other freaking videos is this guy.
Every
you can't have
commercial.
It makes money. Yeah.
Look at what happened to him. Can I mention? I mean, I don't want to mention the name, but he 007. Who I'm talking about. Just got busted by the SEC. And what it was found that he's one of the most popular influencers on the internet regarding penny stock trading, and part of the allegation, and which she's trying to prove, is that this individual wasn't actually even buying the stuff he was talking about. He was either front running it or wasn't even buying the trades he was saying he was making. So it's amazing how bad it is.
I actually look back at legitimate old style boiler rooms, and just basically just link and sit down and say that Twitter and these other forums and such are just the new boiler rooms. Again, there's everybody out there. I just made $25,000. Wow, you can do it too. Buy my subscription for
it's so easy,
$400 a month. It's real. It's just it's definitely unregulated. Put it that way. Okay?
And by the way, I agree with unregulated, and I do think CEOs that are getting aggressive with their pump and dump schemes have been going unchecked, in my opinion. And I don't know if it's always been this way, but more often today than over the last 3 years, I'm seeing new companies pop up that I've never heard of, advertising road shows. And maybe I think it's interesting, so I sign up for a road show and I get a one-on-one with the CEO that I don't know why he's giving me a one-on-one before I ever even spoke to him or did a call with IR. And he's telling me consensus numbers are way too low for the next 2 years, and he's gonna blow out numbers by 3x. And he's telling me all this stuff that should be MNPI. There's no 8Ks, there's no press releases. I personally don't believe anything they say when they're if they tell you that much information on the first conversation they had with you, and you see the stock going up and to the right, they're literally selling you a bag of goods. But you're seeing this happen more often, in my opinion. I don't know if you guys see that too. And it's going unchecked. And, in the medium term, I do think it's leading to increased consumer confidence, which actually is good for the economy, surprisingly. People feel wealthier. They feel like it's easier to become wealthier, so they're more likely to spend. And I do think this is very anecdotal, but between a lot of people I speak to who have started investing in the stock market recently, I think their appetite to spend money and invest, it just seems like their confidence is higher now than it was a year ago. But I just don't see
especially when you talk to crypto investors, that's for sure.
Yeah, I just don't see how it ends well.
Yeah, so the interesting question, here's a question for everybody. What do you see, or have you seen, or what would you attribute to the instigation of the bursting of the bubble? Obviously, it's going up on hype and going up on interest and going up on speculation, crawls the wall of worry, and you know we've all seen that particular chart of how things go up and down. So the question I have is, and this is one of the things I don't know the answer to, and I often speculate, but where do the driving catalysts come from, or where do the catalysts come from that drive the turnaround or the bursting of the bubble?
Yeah, a bubble is formed when demand for assets is higher than the supply for assets. So it's going to burst when one of two things happen. Either demand dries up, and that could be because people run out of money and they're levered to the hill and they can't lever up anymore. They bought everything they can. I don't think we're there yet. Demand could also dry up if interest rates go up, right? If long-term inflation expectations go up, interest rates go up, people may say, I don't need to speculate anymore because I could buy a government bond that's risk-free for 10%. Like, I don't need to speculate, so I'm going to stop buying all the speculative stuff. Yep. That would be the demand side. Or supply, you just get flooded with supply. The more and more of these pump and dumpers and stock promoters see the ability to make an easy buck, and they just keep bringing more and more SPACs to market and more companies that do nothing to market at these multi-billion-dollar valuations. Eventually it's going to overwhelm the supply. So it's one of those two things. And like, you have to believe that the supply is not slowing down. I mean, the supply, as long as there's demand there, the supply will keep coming and coming and coming. So the question is, will people run out of money first because they just, bought all this stuff, or because rates go up, or will supply just come, over the next year and overwhelm all the demand? I'm not sure which it is.
So if I'm listening to media, for example, and I've always been one to play contrarian to media, if the media starts to become rah-rah and big supporters of the rise of the opportunity that exists for all these people, and the media is beginning to open their eyes to it, does that signal a top, regardless of whether the supply and demand exist? I mean, does the media have an influence on the push or the bursting?
I think they have an influence on people's behavior, but not on necessarily the bursting of the bubble. I mean, they can help fuel a bubble, no doubt. They're just like, Wall Street bets and Twitter can help fuel a bubble. The more people see and talk about a bubble, the more it gets reinforced, and the more likely it is to persist until supply or demand, cause it to not persist anymore. So I don't think talking about it stops the bubble. I think if anything, talking about it makes fuels the bubble. Everyone's getting rich. Look at all these stocks going up. Everyone says it's going to end, but no one knows when. It could go on for a lot longer than it seems. And the more people are intrigued by that, they go look at stock charts and they see stock charts are only going up. They're going parabolic. I think you're more and more likely to suck more people in. I think what makes it end is supply or demand. Either there's just too much supply, overwhelms the demand, or demand stops because interest rates go up or people are already too levered. I think those are the two things in my mind.
But also from a non-macro perspective, I mean, is there also a potential here where, some of these companies just continuously put out bad earnings reports and they're burning through cash? I mean, could that potentially lead to it? But I know as I was thinking about that at the same time, it's like the froth is, they don't care. It's growthy names,
the bubble stocks aren't, like Kevin touched on this. The bubble stocks aren't, I'm reporting 20 cents next quarter, and instead I report 22 or 18 cents. I have no revenue and I'm $30 billion. Yeah. And so there's nothing to miss, right? Like whatever targets managements are putting out there, they're not going to miss. They're going to keep pushing them out. And by the way, if you say you're going to create 10 widgets today, but 1 million next year and 1 billion the year after, and you miss your 10 today, does it really matter? Like if people still believe the 1 million the year after and the 1 billion the year after, I mean, today's numbers don't matter to anyone. I think it's people's ability to buy into the narrative. And I don't think that stops until people start to lose money and they're too levered and stocks stop going up. And they'll stop going up either because there's too much supply right? Or because people are pulling money out of the market. I think those are the two things.
By the way, another social.
The point where you can value them as a problem phase company. It's better to have difficulty valuing a company because once they start making money, they can start valuing them, and it becomes worse. And what's amazing too, guys, is they're raising money at these prices too. They're building these continually building their balance sheet up, cycling in by raising money all the time. So at these much higher prices. So I don't know what that does to the whole game, but that's pretty interesting.
I remember back in. Oh, sorry.
It seems odd to me when I start looking at a lot of this Crunchbase information about who's getting money and things of that type and what the VCs are investing in, and some of these investments start to sound very, very crazy. I mean, one of the ones that I saw recently is fake shrimp. Okay, Beyond Meat, of course, is now Beyond Shrimp, and it's one of those things that's saying, okay, I understand that there's people who want to have non-fish, or there are people who have shellfish issues and things of that type, but fake shrimp. What's next? Fake broccoli? I mean,
Look, there's clearly a market. There's clearly a market for these goods. The question is, can you economically produce these goods and sell them for a profit? In a normal world, if you couldn't economically produce them and sell them for a profit, it wouldn't be created. In a world where capital is abundant and people don't care, these businesses are created. And at the end of the day, like the VCs that are funding these concepts, right? Every investor is Pavlov's dog, right? If the bell rings, they keep doing what they're doing. And so when you are funding a business that has no ability to economically succeed, but you see it IPOing for $1 billion or $2 billion valuation, and you see your friends doing that and these people doing that, at the end of the day, all they care about is their exit, right? And that exit is the bell, right? The bell is revenue multiple, TAM, eyeballs, whatever it is. If that's what you're getting rewarded for, that's what you're going to fund, even if it's not economically viable. And so as long as public markets are rewarding that behavior, I think these businesses are going to continue to get funded. And, some of it's good for society. If it's creating products or services that I think people want and need that couldn't be created otherwise, that are long-term good for society, whether it's clean energy or whatnot, I think that's good for society. But where you have promoters just taking advantage of people and raising a lot of money to line their own pockets, I think that's bad. So some of it I'm like, this is absurd and is good for society. Some of it I'm like, this is absurd and these are thieves. I don't think you could paint it all with the same brush, but a lot of it will end badly for investors. That's the bottom line.
Excuse me, I just got an alert bell on my machine over here.
What?
I just got.
He was making a Pavlov's dog joke.
Bad joke.
I got you. The Pavlov's dog joke. You got the bell. No, it's good. Oh shoot, Maj just jumped off, but that's okay. He might be jumping back on in a second. But, I was also going to say one of the other social media phenomenons that we've seen, and I got to say it's one of my favorite Twitter accounts, is TikTok. And I think it's called TikTok Investors, that social media account. I live for it. It's so funny. I mean, some of the stuff that they put out there, but it's funny and yet sad at the same time, because you're seeing a lot of what you all have been saying is just this completely unregulated, talking about stocks, and not all of them have Bobby Kraft in their ears saying like, full disclosure, I don't own that, or full disclosure, I own that. They're just putting it out there, and seeing what happens, and everyone's just assuming they're talking their own book, and I don't know how there would ever be able to regulate something like that, because a new account pops up every day. So I do think social media has really taken over this whole.
I do think that when you look at some of these things, you can see a direct correlation between an influencer who writes something on Twitter or elsewhere in form, whatnot, and an immediate reaction to the share price. I mean, you can see it mostly in the daily. I mean, in the intraday charts. Something happens at 12 o'clock, 12:15, and somebody says, oh, this is going up, blah, blah, blah. You'll all of a sudden see 20,000, 30,000, 50,000 shares fly in like that. So there is an obvious influence driven reaction in the market. Whether or not it's sustainable, or as you said, or whether or not the influencer already owns the share, and then he or she knows that if I push this thing, there's going to be a bump in volume, and I'll sell into it.
And it's not like this is anything new either. I mean, this has been around for years. I mean, these social media accounts have been around for years, but it's really been amplified this year, whether you want to say it's the Robin Hood effect, Dave Portnoy effect, whatever it is. But I mean, people staying at home more, you're on social media more, wanting to, look at ways in which you can build generational wealth because you're sitting at home, either collecting unemployment or you're out of a job. I mean, you're very susceptible to some of these things. My hope is that I hope to see everybody take that next step, right? And, be like the Kevins and the Majes and the Yarons, where it's like, all right, let me take the next step in my investing strategy and process where, okay, analyzing the mistakes or analyzing the good things that you did and trying to create a strategy around that, so that you're really, just I don't know, an active participant in a much more positive way, rather than just buying and selling names that you see and have no idea what they're doing. But
you're just saying you want to see people mature and operate like real OGs.
Operate like real OGs. I mean, look, hey, look, there's no right or wrong way. Look, if you have your own strategy and that game works for you, hey, power to you, make it work. I hope you become a billionaire. Like, make it happen. But I think we can all agree that the majority aren't doing that just yet, and have
look, I don't know.
I don't know. I mean, I'm speculating, of course, but
yeah, look, we're talking about that, but this is going on for years, man. I mean, it's just more amplified now. We notice it more social media, but it was going on in the 80s, 90s. We're just more aware of it now. We talk about it more. So it's just part of the market and we have to deal with it. Right. And, some of us are going to make money. Some of us aren't. We're all going to go through, even we go through bad times in our strategies. So, I think it's wrong. It's not right to be mad at the market or think, oh, the market's bad or regulators are bad. This is just the market, man. We're in a free economy. It's how capital markets work. And in order to make money, you need to have this stuff. You need to have this open type of atmosphere to be able to trade in and make money in. And we're all trying to chase the dreams, and some of us will do it, and some of us will have challenges along the way. But I think it's wrong to be mad and criticize it too much. Just be ready for sure. Just be ready for things when things do go bad. We just got to be ready for it and know how to basically make sure that our lives are all structured in a way financially or mentally that we can handle. Pull back.
Well, I guess my point in saying that was for those listening that maybe be employing that strategy of not knowing the names or anything like that, doing great. It's just to not get mad if things do potentially blow up for you and wanting them to just issue that warning of hey, it could blow up, don't think that this is going to keep going up forever. So just wanting to have a contingency plan for when you potentially could blow up. I hope you don't, but having the plan in place is definitely something.
This is when you begin to talk about the emotional aspects of the market and the emotional aspects of trying to state that I'm right. Okay, I have been right and I will be right. And God damn it, this is going to work out for me. I think that type of behavioral, emotional aspect of the market is also something that one has to kind of self-evaluate with. One of the fellows said, be prepared. I think it was Maj said, just be prepared. And I think that's quite true. You just have to be prepared. You have to understand, how to get out, when to get out, when you're actually going to be, operating in a level where you're out of your league, things of that type. So again, figure out what your exits are going to be if the thing hits the fan, And the fan's right behind Maj. It's probably already stuck on there from past activities.
Actually, it's not on. It's right.
All right. Well, I think we hit all the major points about why microcaps are surging right now. I mean, if there's any last minute things that we missed, please, anybody jump in. But otherwise, I think we're pretty much there. I know a couple of you guys have some hard stops. So, love to get everybody's final take on this topic and then where people can go and find more information about you. So Yaron, let's start with you.
Yeah, my last take on why stocks are surging, which we haven't touched on, is because Bobby Kraft is doing such a great job highlighting microcap managers and stocks. So you're interviewing CEOs, and good job, Bobby. Thanks. We all owe you a beer, all of us microcap investors.
I know Maj finds all his ideas from every one of my CEO interviews.
Yeah, exactly.
He doesn't want to admit it, but I know he does.
Yeah. But yeah, everyone who's a regular listener should know where to find me. But if you are not a regular listener, you can find me on Twitter. I'm at One Main Capital, the number one, the word Main Capital, and my contact info is on there as well. So feel free to reach out.
Very cool. Thank you, Yaron. Kevin?
Well, I'm still at the Good Prick, which of course follows surging, like the market
Like
itself.
the markets. Yep.
Yeah. Oh, there you go.
Yeah.
But no, I think all the commentary that was here was quite valuable from the macro levels that I think that we are operating in through the good opportunities and the bad opportunities. I think we talked about the boiler rooms and how they affect markets, bubbles and things of that type. So I think we covered the space pretty well. And that would be, I think it would be very well served if people did in fact begin to understand that these are the various elements that come into play in the market.
Very good. Thank you, Kevin. And our next goal for Kevin that, we'll talk about at some point is getting into 1,000 followers. So let's get him up there. And all right, Maj, your final take and where people can find more information.
Yeah, well, thanks, Bobby, for doing this. And it's a topic I love. And just look, I don't really know where markets are going, and I don't predict markets or try to do that too much. But I'm optimistic about where the space is going, and I hope it continues. I think it will continue the next few years to garner interest in the nanocaps, MicroCaps. So hopefully it goes that way. You can follow me. My personal Twitter is Maj GeoInvesting. Of course, GeoInvesting is at GeoInvesting, and GeoInvesting.com is our the website where we highlight these strategies in the nanocap space and microcap space, tier 1 companies, and we offer a free trial. So.
Yeah, that free trial. And also Maj is the host of Avoiding the Crowd with Maj Soueidan, that, the hottest new microcap podcast in the market right now. We're adding to more content to your investing listenership to hopefully not confuse you more on what to do. Definitely go and check.
That the space is hot.
What was that?
If we get 5 investors to listen to the podcast, we're hot in that space.
Yeah, that's true. Well, you can go and listen to that on anywhere that you get podcasts. You can also see it on the SNN Network YouTube channel at youtube.com/SNNWire, and also on geoinvesting.com. You can see every episode there. And with that, I got nothing else to plug. This was a great episode. Thank you all for joining me today. This was a lot of fun, and I'll catch you all again soon.
Bye, guys. Thank you.
Thanks, guys.
Nice.
Thanks, guys.